Missed that part. That's kind of important. All right, so we will get going. Welcome. For those of you who don't know me, I'm Miss Bentley. I'm one of the accounting teachers here. Appreciate you joining me today. The goal of these different sessions we've been having this semester is just to give everybody an opportunity together and do a little comprehensive review to help you prepare for our different tests. So obviously you all have test 3 coming up, covering chapters 7, 8, and 9. Our goal today is to go through a couple of big problems related to the information in those chapters. So it's not going to hit everything, but again, most of the problem type things you need to know how to do for unit 3, we're going to hit on today. I'm gonna ask for your grace in advance. This room is not super ideal for this type of setup. I like to be able to write on stuff up here to where I can write some things out as we go through solutions. We'll see how it goes. We're just going in and go through and hopefully help you get a little better prepared for your test. And I'm gonna shut this door real quick. There we go. All right. If you didn't grab it when we came in, there's worksheets up here of these problems. So I know the screen's kind of hard to see. There's scrap paper. Feel free to grab that. There's pencils, all the things that you might need. Feel free to grab whatever you need as we go. Feel free to always stop me as well at any point in time. So, thinking way back to chapter 7. Chapter 7's biggest topic was inventory cost flow assumptions. So we looked at FIFO, LIFO, and average cost. You probably also spent a couple minutes at least on specific identification. Thinking about specific identification, remember that's the one inventory method that does, have to match the physical flow of the inventory. So a specific identification, we have to know every time we sell a specific inventory item, which one it was. But with all of our LIFO and average cost, we just make an assumption because we're selling a bunch of identical inventory items that just happen to have different costs. So in this example, we have 144 items in inventory, but you'll notice we've made purchases at different times at different costs. 144 identical units. And we just want to know, okay, when we sell 121 of those, how much then of this $15,510 total cost in inventory, how much of it ends up on the income statement as cost of goods sold? How much stays on the balance sheet in our ending inventory account for the items that we didn't sell? Because basically what happens in this scenario is 44 items available, 121 of those are going to end up in cost of goods sold. The other, what's that, 23 items that we didn't sell, the cost of the items we didn't sell stay in ending inventory at the end of the period. So we've got to figure out, of this $15,510, how much is cost of goods sold, how much is ending inventory, and the cost flow method we choose is going to determine how we come up with that amount. So I'm just going to pop over to the solution and then some of these I'll write out and some we'll just kind of look at it as we go. But what happens under FIFO? It's really important to think. So when we think about FIFO stands, I'm sorry, not FIFO. FIFO stands for first in, first out. We are assuming that the oldest items in inventory are what we sell first. Again, doesn't have to be true. It's just an assumption. But under that assumption, we assume that the oldest items are what end up in cost of goods sold. The newest items are what end up in our. So what's going on is if we think about, get this to do right. Nope. Let's get it to the right spot. There we go, maybe. This is not gonna work very well. We sold the 121. Oh, I'm just gonna make a mess of this. This is important. Okay, under life or FIFO, we sold the 121 oldest items. What remains in ending inventory at the end of the period is gonna be the 23 newest items. So what happens is people have preferences in how they want to calculate the ending inventory and kind of back into the cost of goods sold. I personally like to calculate the cost of goods sold piece because it's what makes sense in my brain as we think about first. Okay. The cost of goods sold is what goes out. So if we think about the cost of goods sold, we sold 121 items. If the first in is the first out, that means we assume we sold. That means the newest stuff is what remains in ending inventory. Now, we calculate either one and back into the other one, but we're just gonna go with this one because cost of goods sold, 121 oldest items. Okay. That means we start with our oldest inventory layer. So if you look at what I gave you, the oldest items in inventory are these 25 units that cost $100 a piece. The next oldest are the 45 at 106. We keep moving down through those inventory layers until we get to 121 items. And so what happens is, again, we took all of those first three layers. When we look at that last inventory layer that had 112, I'm sorry, that had 50 units at $112, we didn't sell all of those. Everything. We only sold 121 items. So the up to 121. And then we're going to add up our total cost. Our ending inventory is, well, what's left over after we sold the 121 oldest items are the 23 newest. And so that's what remains. With these, you can also always kind of back into one of the numbers because we can say for any of these methods, and keep going around the screen right here. If we think about being left-handed does not work well on this little pen thing, by the way, because it keeps putting hairs aside. Nope, didn't mean to do that. Yeah, this is not gonna work. Whatever, that says goods available for sale. Goods available for sale minus our ending inventory gives us our cost of goods sold. Well, that works either way. So we know our goods available for sale is this $15,510. That's the total we had the ability to sell. If we figure out one of the other of these, we can back into the other one. So if you are more comfortable calculating the ending inventory first, if you said, hey, I know the ending inventory is just the 23 newest items, let's do one calculation. You could have gotten to cost of goods sold by taking the 15,510 minus 2556 to get you to cost of goods sold. Or you got the cost of goods sold first. You could have taken the 15,510 minus the 12,934, come up with the ending inventory. Either way, the total of your cost of goods sold and ending inventory has to total that 15,510 in inventory. Just the key is when we think about FIFO, again, you assume the oldest stuff is what we sell first. Questions on FIFO? Okay, so FIFO, first in, first out. LIFO works the opposite, because LIFO is last in, first out. LIFO assumes that the newest items in inventory are what we sell first. So under all three methods, what we're trying to come up with is which 121 items are we assuming we sold? Which 23 items are we assuming remain in ending inventory? And under like that cost of goods sold, again, it's still 121 items, but in the case of LIFO, my cost of goods sold is made up of, get to the right-ish spot. The 121 newest items in inventory. What's left in ending inventory then under LIFO, it's going to be the 23 oldest. And I feel like if you can get comfortable with which where, which one's the old, which one's the new, it makes it a whole lot easier to figure out. So again, thinking about LIFO, the old stuff, sorry, FIFO, the old stuff is what we sell. LIFO, we assume the new stuff is what we sell.
So for the amount of units that we have, that should price.
Yes.
Between the two, okay.
Exactly. Okay, just in the case of LIFO, you know, with FIFO, remember we started with the newest or the oldest stuff, we started at the top, the 25 units at 100. Notice that with LIFO, we started with the newest items. Our most recent purchase is what we assume we sell first. So we start with the newest inventory layer and move up through those. But again, no matter what method, the total units in cost of goods sold has to add up to 121. The total units in ending inventory have to add up to, okay, it's just a difference in which items we assume went where. So with both of those, we've got to deal with the different inventory layers and all that. Does anybody remember FIFO is the most popular method? Does anybody remember why? Does anybody remember one of the advantages of FIFO?
Some sort of tax.
That's LIFO. When we think about FIFO, does anybody remember the primary advantage there?
Higher gross profit.
Yes. With FIFO, if we are in periods of rising prices, which is most typically the case, in periods of rising prices, FIFO will always give you, notice here, the lowest cost of goods sold, which means it gives you the highest gross profit. Okay, higher gross profit means higher net income. So if you're trying to maximize what you report as your profit, just based on inventory method, you're going to choose FIFO. Okay? We got a preview of the benefit of LIFO. The benefit of LIFO, we look at it and we go, okay, well, LIFO gives us the high. Why would we want to choose something that gives us a high cost? Because higher cost means lower profit, lower net income. And the only reason ever you want to report a lower income than you would otherwise have to is to save on taxes. Okay, so the primary advantage of LIFO is minimize your income taxes. Okay, we pay less taxes. So most companies are going to use one of those two, but there is a third option because some companies say these layers are annoying and I don't want to deal with all these different layers. I want to just assign the same cost to every unit in my inventory. Rather than say, okay, well, some are $100, some are $106, you know, whatever. Just give them the same cost. Let's just come up with an average. Just come up with your average cost per unit, and then you multiply that same number by the number of units in ending inventory and the number go back. Where we were, that'll go away. Get this to the bottom. Oh, did I close out my other thing? It's not good. Let me see over here. There we go. Remember, our total cost in inventory was $15,510. Of those 144 items. So to get the average, we just take the total cost in inventory, so that 15,510 divided by our units in inventory. Once we have that, we can come up with our cost of goods sold by taking that average cost times that we sold. To get ending inventory, we take our average cost per unit times number of units that are left in ending inventory. One other thing this problem asked us, it asked us to calculate the gross profit under each method. Remember that your gross profit is your sales minus your cost of goods sold. And sales does not change, no matter which method we're using, okay? Because it told us in the given information, we sold 121 items for $170 a piece. So our sales is $20,570, no matter which method we use. But remember, what does change, depending on the method, is the amount we report as cost of goods sold. So once you've figured out your cost of goods sold, it's not that hard to come up with your gross profit because again, the sales number stays the same. All we've got to do is subtract the different cost of goods sold amounts. One other thing on this one, it asked us a couple of conceptual questions and we kind of talked about this already a little bit. Again, which method results in the highest net income? That will always be FIFO. Okay, we said which one's gonna minimize taxes, that's not asked on here, but just so you know, LIFO is the one that's gonna minimize our taxes. Then when we think about which method results in a larger amount reported for assets on the balance sheet, well, that one's also FIFO, which is the other kind of benefit of FIFO. The primary benefit of FIFO is that it's net income because it's the lowest cost, but the amount in ending inventory that most closely replicates our current cost. Okay, because our current cost is our most recent cost. And so if we really want an ending inventory number that closely matches the current value of that inventory, that's another major benefit of using FIFO as your inventory method. You get the highest net income and the highest amount for assets on our balance sheet. So think about those inventory methods. Any questions on what's going on there? Well, anything else? Before we jump on? Okay. Got us into looking at receivables. Okay, so we spent a good bit of chapter 8 talking about uncollectible accounts receivables. Then we spent a little bit of time talking notes receivable. So the chapter 8 question 1 relates to the uncollectible accounts stuff. Question 2 looks at notes receivable. As we think first though about accounts receivable, you had to learn in chapter 8 how to use that allowance method to deal with uncollectible accounts receivables. Because we need to be able to, at the end of the year, estimate our bad debt expense based on our expectation related to uncollectible accounts receivables. The ones that we don't think the customer is going to pay us is essentially what makes up an uncollectible account. And with that, we need to be able to do that adjusting entry at the end of the year. We also need to be able to, as, customer-specific accounts are determined to be uncollectible, we need to be able to write those off as they are deemed uncollectible. And then the one other journal entry thing related to uncollectible accounts receivables was what happens if we've written off a customer's account and then they come back and pay us? What happens if we've on a receivable that we previously wrote off? So this problem kind of the beginning balances in accounts receivable and the allowance for doubtful accounts, then it tells us that during the year, we wrote off $22,200 worth of accounts receivables. Then one of those was later collected with a collection on a written off receivable. Then we get to the end of the year and we need to be able to do our adjusting entry for bad debt expense. This is one where I really might have to just use the board because I've got the answers for us, but it kind of helps to look at where those answers. Because first thing here, it told us that during 2025, they wrote off accounts totaling $22,200. Nothing to that. They write off every time when we write off an uncollectible account. We debit the allowance for doubtful accounts. We credit accounts receivable. Okay. Write-off will always be the exact same thing. Then remember it that we collected 3,000 of those receivables that we've written off. So we wrote off one customer's account and then paid us. Well, when a customer comes back and pays us after we've written off their account, it takes 2 journal entries to handle that collection. Because first we've got to reverse the write-off. Hey, we gotta go, oops, we didn't need to write that off. Yay, they actually paid us and we didn't think they were going to. Debited the allowance for doubtful accounts and credited accounts receivable. The write-off does the opposite. Okay, it debits accounts receivable and credits the allowance for doubtful accounts. Okay, receivable back so that we have something to show that the cash receives cash. They don't just throw the cash in the bank and not keep track of where it came from. We've got to have a record of who paid us. And so if that customer's account has hey, we got some cash, and now we can remove that. They had written off like we had originally reported. Any question on that piece? Because again, those are just knowing the entries. Okay, a write-off will debit the allowance, credit accounts receivable. In the situation where we collect on something that we previously wrote off, we reverse the write-off and collect cash. To think a little bit more is on that bad debt expense entry. Okay, when we make at the end of the year. Because if you think back, there's really kind of 3 options for how we record the bad debt expense. One, we could use the percentage of credit sales method. Remember that method? We just take the credit sales times the percent uncollectible, we're done. But if we're using our aging of accounts receivable method, it takes an extra step essentially to get to that bad debt expense. And that's where I really need to write some stuff down. But we'll see how this goes. Like I said, I may have to just go over to the board and write it there because I don't have much hope that this is going to go well, because this thing does not really seem to like me. But let's look at, nope. All right, so far so good. We got an allowance for doubtful accounts. account there, okay? Let's think through what we got. Because it told us in our problem that, on December 31st, 2024, we had a balance in accounts receivable of 400,000, 25,000 in the allowance for doubtful accounts. Okay. Started with 24,000 is what that is supposed to say. Well, then we did a couple of entries that impacted the allowance for doubtful accounts. And wow, on your test, you will not have to do this many steps to get to the bad debt expense entry. I'll show you where you would need to be able to get from, but just for sake of this problem, we had to think a little bit extra because we need to then think about, okay, this is where we started with the allowance for doubtful accounts. Well, then these different things impacted the allowance for doubtful accounts during the year. We debited the allowance for $22,200 for the write-off. And we also credited the allowance for doubtful accounts for $300 for the amount that we. So let's post those to that allowance for doubtful accounts and see where we're at. Because. Okay, magic pen, let's work. Okay. All right, we're there so far. Okay, because that's just this 20,200 that we debited to the allowance for doubtful accounts. Then over here, we credited the allowance for doubtful accounts for 3,000. So that's everything that happened in the allowance for doubtful accounts all throughout the year. So at the end of the year, we're going to calculate the balance in the allowance before we adjust it. So if we look at 24,000 plus 3,000 minus 22,200, we have an unadjusted credit balance. In this case, of $40 in the allowance for doubtful accounts. Now, on your test, basically what's going to happen is if you're asked a question about the aging of accounts receivable, this is going to be your starting point. Okay, it's going to say you have an unadjusted credit balance of $4,800 in the allowance for doubtful accounts. And as it tells us here, at December 31st, 2025, an agent indicated that the balance in the allowance for doubtful accounts should be 32,000. Extra step come in. Because right now we've got $4,800 in the allowance for doubtful accounts. But we just said that the balance needs to be. The balance needs to be. Oh, there's a typo on that journal entry. Glad we did this together. Needs to be 32,000. Okay, your journal entry for bad debt expense is always going to be whatever needs to be added to doubtful accounts to get it to 32,000. So if we've got 4,800, which now I'm going to check my math on here and make sure we're good. That's where I went wrong. I knew something was. There's a couple things wrong here. First of all, that should be 25,000 is what it tells us is the unadjusted balance. See, that's what happens. Right things in the right spot instead of paying attention to what's going on. So we started with 25. Yeah. We'll work through it. And then minus the 22. So that should actually be 5,800. But so. what we need to record here as bad debt expense. $26,200. So again, this amount here is not quite right. Actually. That bad debt expense, when we're using the aging of accounts receivables method, that bad debt expense that we record is always whatever needs to be added to the allowance to get to the balance we need. Remember to always pay attention to the unadjusted balance before, because the difference between those is what's gonna give you your bad debt expense. When they say we estimate that 32,000 in accounts receivable will be uncollectible, that $32,000 is not the amount of our bad debt expense. The amount of our bad debt expense is whatever we need to add to the allowance to get there. The other thing is to make sure you're paying attention to in one of these problems, is the unadjusted balance a debit or a credit? Because it can't be either. There's a possibility we could have written off more than what we estimated last year. So always pay attention in those problems. Is the unadjusted balance a debit or a credit? Because no matter what it is, the bad debt expense will always be whatever we need to add to it to get to the balance that we estimate to be uncollectible.
Is the beginning of the number always gonna be credit
Yes,
when we start? Okay.
absolutely. Because the allowance for doubtful accounts is a contra asset. Contra assets always have a normal credit balance. Okay, that doesn't mean we can't debit and credit these throughout the year, but by the time, we're gonna start at a credit and we're gonna end at a credit eventually. Okay, you can have stuff all either way throughout the year, but it's gonna start there, it's gonna end there, because it's a contra asset. Its job is to decrease the balance of the accounts receivables that it attaches to. Questions on uncollectible accounts receivables? Okay, just real quick, thinking conceptually about things related to uncollectible accounts receivables. You want to remember stuff like that. We use that allowance method. Again, it's kind of weird that we have to do all this stuff. We do it this way where we estimate bad debt expense at the end of the year. We do that to achieve our matching principle. Because remember we said the matching principle records expenses in the period where they match the revenue they relate to. We want to record the bad debt expense in the year when the sale happened, even though we know that we won't identify the specific account usually until some point in the future. Do it on uncollectible accounts receivables. All right. Well, let's talk notes, because notes receivable was the other piece of number 8. I can find my notes here. So if we look at question 2 here, we're looking at a note receivable. The biggest thing to be able to do is to calculate the interest revenue that we need to accrue at the end of the year when we do adjusting entries, and then the interest revenue when the note matures. Because anytime a note crosses over between calendar years, rather than including all the revenue when we receive the cash, when the note matures, we've got to make sure in the year when it is earned. Again, it's one of those applications of that revenue recognition. Rule accounting, we record revenue when it's earned, regardless of when we receive the cash. So we receive, or we earn the revenue as time passes. So in this case, if we loan the money on November 1st, on December 31st, we're gonna need to recognize we've earned 2 months of revenue on this note. We're not getting cash for it yet, but we've earned the money because we've given our customer this money to borrow at a 10% interest rate. So at the end of December, we have to go and recognize 2 months worth of interest, because November 1st through December 31st is 2 months. When we get into the following year and the other 7 months of that loan happen, we've got to record the other 7 months of revenue, because the revenue gets split between calendar years when it is earned. So when we think about our journal entries related to notes receivable, again, the entry to issue that receivable, no big deal there. We debit notes receivable, credit cash. The ones that require some calculation are the interest entries. And again, when we think about what's at the end of the year, when we do adjusting entries, we've got to record an interest receivable and interest revenue for the amount of interest that we've earned. As we think about our interest formula, and I'm sorry that I'm having to write stuff because it is just so ugly, but we're gonna try. Our interest revenue is always equal to the principal amount we loaned. So in the case of December 31st, that's ugly, we're looking at $20,000 times our interest rate. Times our number of months out of 12. Remember that interest rates are always given as annual rates, regardless of the term of the loan. So this is only a 9-month loan. So a lot of people want to go, oh, well, then we need to take 2/9 because it's only 9 months. No, it's always out of 12, because that interest rate you were quoted is always quoted as an annual rate, no matter what the term of the loan is. In this case, this $333 in interest revenue in 2024 is from the loan that happened in 2024. Well, then, more time passes. We get to 2025, and on August 1st, our customer's gonna pay us back. When they pay us back, the second entry is actually the easy one. They're obviously the $20,000 that they borrowed, so we're gonna get cash for that. But we're also gonna receive the cash for the interest. Is the amount for the whole 9 months. Okay, that $1,500, I'm not gonna try to write it again, but just to tell you where it is, it's the $20,000 times 10% times 9/12, because the cash is for the entire loan. And when we look at where that comes from, part of it is removing that interest receivable from last year. Because what we already recorded as revenue last year and as a receivable, that receivable's got to be removed. The customer doesn't owe us that anymore now that they're paying it. Then we've also got to record some additional interest revenue. Because again, 2 months of the loan were revenue up here in 2024. The other 7 months of the loan are interest revenue in 2025. So this 1167, that's the 20,000 times 10% times 7/12. Because that's for the 7 months that happened in 2025.
Where we get the 333?
The 333 is the 20,000 times 2/12. Because we loan the money on November 1st, and then at the end of the year, we have to do adjusting entries on December 31st. So it's November and December is the 2 months of revenue we've got to earn in that first year. Then the other 7 months get recorded as revenue in the following year. But like I said, the total of those is going to be the total 1,500 we made for the full 9 months from that note. So when it comes to notes receivable, like I said, calculating that interest, is the main thing you need to be able to do. Remembering that at the end of the year, that year-end adjusting entry is based on however many months that you loan the money through the end of the year. And then at the payment date, it's from the beginning of the year through that date, is how much revenue you have in the second. Questions on it?
So the 1,500 is from the total amount of interest you're gonna earn from
For the whole life of the loan, because that's how much they're gonna pay you when it's due, they're gonna pay you. So to get that amount, you can do two things. First is, you could say 20,000 times 10% times 9/12, because 9 months is the total life of the loan. If you had already calculated both of these, you got the 333 for the 2 months, the 1167 for the other 7, the total of that is gonna give you the 1,500.
So if you were to do it, if you were to do it indifferently, like say you wouldn't already put the journal entry for credit of interest 33, and just did the cash and then interest revenue for the whole. Then would that be wrong?
Yes.
Okay, so you have to.
That would absolutely be wrong, because under accrual accounting, we have to record revenue in the period when it's earned,
Okay.
no matter when the cash happened. So again, logically, that's what most people would think you would do. Like, why am I splitting it up?
Right.
The point of doing that is that we've earned money, in this case, in 2024, even though we haven't been paid yet, because our customer has our money at that interest rate. If they, let's say they paid us back January 1st, we wouldn't say, oh, you don't owe us any interest because you didn't borrow the money the whole time. Of course they owe you interest. They owe you interest for however long that money was outstanding. And so that 2 months that it's been outstanding, they owe you that money, even though they're not gonna pay the cash until the end.
So the new interest revenue that you did, that equation, but instead of the 2 divided by 12, it was 7 divided by 12?
Exactly. Because again, the term of the loan, the whole term is 9 months. That's the whole 1,500. But because it crossed over between years, we gotta look at 2 months of it in 2024. So 2 months is revenue in 2024. 7 months happened in 2025. So 7 months is revenue in 2025. So it's 9 months total, just because it crossed over between years. Part of it's revenue in the first year, part of it's revenue in the second. Questions on interest? Cool, then let's talk depreciation.
Before you run off,
Uh-huh.
in chapter 8, the last bit of receivables turnover analysis, and I was going to ask how might that be assessed on a question, like how are we gonna have to find that?
Receivables turnover, you might just need to be able to use the formula.
Okay.
Um,
In terms of the question phrasing, because that's where I get tripped up the most, is that I'll study a certain formula and try to build questions for it, and then it's just phrased in a completely, to me, outlandish way. So what can I sort of expect in terms of like, what kind of question?
If you were asked a question about accounts receivable turnover, it would say, this year, a company had sales of $100 million with average accounts receivable of 143,000. What's accounts receivable turnover?
So just be asking.
Yeah. Yeah, it'd be straightforward like that. Okay. Your chapters, what is it? Chapter 7, 8 stuff. All right, so let's think chapter 9. Because chapter 9 is where we look at purchases of long-term assets, depreciating those assets over their useful life, and then disposing of those assets. So the question here primarily pertains to depreciation. Just a couple things in advance of that. Remember, first thing we talked about as it relates to those tangible assets is that when we purchase equipment, land, building, any of those things, that the purchase price of our asset is the cost of the asset, of course, plus any costs that are reasonable and necessary to get that asset ready for use. Okay, so sometimes there are costs associated with getting an asset ready for use, and it's cost. Okay, we had a special term for, that we record as assets. Does anybody remember what happened, what we call that? Yep. Absolutely. We capitalize a cost when we record it as an asset. Okay, so things like the shipping cost on a piece of equipment, we include that in the cost of the equipment. We capitalize it. When we capitalize something, that increases the value of our asset. Okay, so we record the purchase price of that asset. Well, then we need to be able to depreciate that asset over its useful life. And so you learn 3 different methods for straight line, units of production, and double declining balance. And they're just different cost allocation methods. Okay, none of those have declining value of the asset. All they're doing is transferring the cost from the asset to expense over the life of that asset. And they just do it in slightly different ways. So in this case, we're looking at $120,000 machine. This problem says salvage value, just so you know, salvage value and residual value are the same thing. This is an older example and I didn't update the wording. Residual value is $12,000 here. And it tells us we expect to use 1,000 hours during its 5-year life. 5 years is the main thing we're going to use, but we'll need to use those hours when we get to the depreciation expense for the first 2 years. Because again, on a test, none of us are going to make you do like 5 years worth of depreciation calculations. Years 1 and 2 are fair game as it relates to being able to come up with the depreciation expense and or tell me what's the book value at the end of year 1, year 2. But again, I'm never going to ask you in Strickland, Dr. Montgomery, nobody's going to say, hey, what's your 5's, depreciation expense? You don't have to go that far. But first 2 years, absolutely fair game with all 3 methods. So let's take a look. Because straight line depreciation is our simplest one. With line depreciation, we take the same amount of depreciation expense for each full year of the asset's life. So straight line, we calculate it once, and it's the same amount every year. We take our cost minus our residual value divided by our estimated useful life. So in this case, for this asset, we're going to take $21,600 in depreciation expense every year. Okay, so straightforward, not a whole lot to it. We do need to remember though, what it means to calculate the book of an asset. Your book value is the cost of the asset minus the balance in accumulated depreciation. So thinking about the book value at the end of the 2nd year, well, the cost is $120,000. At the end of 2 years, we've taken, what's that, $43,200 in depreciation. So my book value, again, $120,000 cost minus the balance in accumulated depreciation. So you want to know how to both come up with the depreciation expense and know how to calculate book value. Okay. Questions on straight line? Okay, so straight line is number 1, same amount, we spread out evenly. Yes, sir.
I'm sorry, can you explain how you get the book value again?
Absolutely. Your book value is so our cost. Remember, the balance in accumulated depreciation is growing every year. So if we've recorded 2 years of depreciation, so if we've done $21,600 in the first year, and then another $21,600 in the 2nd year, our balance in accumulated depreciation is $43,200. So $120,000 minus that $43,200, the book value. We okay on straight line? Okay, so straight line, we do it once. We're in good shape. Life is good. let's actually jump to units of production. We'll go back to double declining balance. Units of production is very similar in how we calculate our depreciation rate. Just with units of production, the goal there is to more closely match our depreciation expense with the actual usage of our asset. Under no circumstances are companies required to do that. It's not the purpose of depreciation, but sometimes they just like to. They say, I would really like if my depreciation expense more closely matched how I use it. So they're gonna keep track of the actual usage of their asset and use depreciation expense. What happens when we do that is that the first thing we have to come up with is our depreciation rate per whatever unit it is that we're measuring activity by. So hours, miles, machine hours, whatever the case may be. In this case, we're tracking usage based on the number of hours. And it told us we estimated 10,000 hours. If we go back to where we started. Remember, we said we expected to use it for 10,000 hours during its 5-year life. So when we calculated that depreciation rate, again, the time, just like straight line, cost minus residual value, but instead of dividing by years, we divide by the estimated number of hours. So if we think we're going to use that machine 10,000 hours, that means we're going to depreciate it at the rate of $10.80 per hour. But then every year we've got to recalculate our, because even though we're going to use that same rate every year, our activity is different every year. In 2024, we used the machine for 700 hours. So to get depreciation expense, we take that 1080 times the 700 hours that we used it in 20. 750 hours, 1080 times 750 will get us to our depreciation expense. So it's the same formula every year, the same rate. We just have to multiply it by a different number of hours. So again, for a company to use units of production, because you've got to keep track of the actual usage of your asset. The process is pretty straightforward every time, just that depreciation actual usage. And again, book value always cost. In this case, the total of the 2 years worth of depreciation, whatever that number happens to come to. So 120 minus the balance and accumulated depreciation gets you to your book value. What kind of account, by the way, is accumulated depreciation? It is a contra asset. So remember, on this test, you're dealing with 2 different contra assets. In chapter 8, we had the allowance for doubtful accounts. That's our contra asset to accounts receivable. Then here in chapter 9, we've got accumulated depreciation, which is our contra asset to our equipment or building accounts. Okay, our tangible assets that we're depreciating. Okay, then last method here before we get to disposing of it. Double declining balance is an accelerated depreciation method. What happens under double declining balance is we're going to take high depreciation expense in the early years of the asset's life. It decreases every year because under double declining balance, our depreciation formula is we're going to take the book value of the asset times 2 over our useful life, whatever happens to be. So we'll take the book value times 2 over 5. This one, we have to recalculate depreciation expense every year, because every year the book value decreases. Okay, so as the book value is decreasing, our depreciation expense is going to decrease.
What did you say, there's a contract for this one again?
Accumulated depreciation.
Accumulated.
Yep. So allowance for doubtful accounts is our contra asset to accounts receivable. Accumulated depreciation is our contra asset to our tangible assets.
So we use 2/5 for 2024, even though it's the first year.
Yeah, it's always book value times 2 over the useful life. It'll be that same rate every single year. So no. Cost, because there is no accumulated depreciation. 120 times 2/5, we've got $48,000 in depreciation expense in that first year. Well, when we think about what that does to our book value, because in double declining balance, we have to recalculate our book value every year. Okay, so at the end of year 1, we just recorded $48,000 in accumulated depreciation. Remember, book value, cost minus accumulated depreciation. So 120,000 minus 48,000. At the end of year 1, my book value is $72,000. That is going to be my starting point for 2. Because in year 2, now we've got a new book value. So we're going to take in year 2, the 72,000 times 2 over my useful life of 5 years in this case, to give us depreciation expense in year 2 of $28,800. So the idea with double declining balance, like I said, starts high and is going to decrease over time. Every year it's going to be less than it was than the year before, because every year the book value is lower than it was the year before. Book value goes down. The balance in accumulated depreciation is going up every year. As we depreciate more, that increases my balance in accumulated depreciation. So my book value gets smaller and smaller every year. On depreciation.
Yeah, can you just explain, what you just said more?
And this is being recorded, and so your teacher will get it later and can post it up in Canvas as well. So this whole session is being recorded, but you're welcome to record everything too.
And you just, what were you just saying, it all goes down every year, the book value goes up?
Yep, okay. Every year, as we depreciate an asset more and more, the balance in accumulated depreciation grows. Because like year 1, we recorded $48,000 in depreciation. 800. Well, that's going to be added to what's already there. So every year, the balance in accumulated depreciation grows by whatever that year's depreciation expense was. So in year 2, we've got a bigger balance in accumulated depreciation. So my book value is smaller because my book value is always $120,000 cost minus whatever that balance is in accumulated depreciation. Since accumulated depreciation is bigger, my book value gets smaller and smaller.
And does that only apply to double the credit balance? Or
Nope,
that apply to all of it?
That applies to all of them, because all of them, every year that balance in accumulated depreciation is growing bigger and bigger, which means that book value is growing smaller and smaller. By the time an asset is fully depreciated, if we made you do all 5 years, by the time you got to the end of year 5, the book value would be equal to the residual value. Okay, it would only be $12,000 at the end of the asset's life because we would have transferred everything else depreciation expense.
And what exactly does residual value mean, like, all of it?
Good question. On your sheet, it says salvage value. They're the same thing, but residual value is what you'll see on your test, just so you know. But residual value is how much you bought this asset for $120,000. I think, because remember, both of these are estimates and the useful life. You buy it, you go, okay, I think I'm going to use it for 5 years, and I think that the end of this life. Not to be exact, it doesn't really matter. The idea is you don't want to depreciate an asset all the way down to 0. It doesn't matter when you're done with it. The last piece then, assets. So we buy a piece of equipment, we use it for however long we do, and then when we're done with it, we sell it to somebody else. Well, when we sell it, we've got to be able to take it off our books. Okay, when we sell it, we've got to figure out, first off, did we sell it at a gain or a loss? So that's the problem. And then also, we've got to understand what that journal entry looks like to dispose of that asset. So thinking about this one, tells us in part B, to assume we use straight line depreciation, what amount of gain or loss would we recognize if we sell the asset, again, at the end of those 2 years? Yeah, didn't make you do any more extra calculations. She said, okay, if after these 2 years, if on January 1st of 2026, we sell that equipment for $70,000, okay, for whatever reason, we don't want it anymore. We're gonna sell it to somebody else. We sell it for $70,000. Did we sell it at a gain or a loss? And how do we record that disposal of our asset? And so what that's gonna look like, your gain or loss will compare the cash you sold it for to the current book value of the asset. And remember, we already calculated that book value, because that's what I told you, we're gonna use straight line depreciation. Up here, straight line, we figured out the book value at the end of 2025 was $76,800. Well, so if we've got a book value of $76,800, but we only sold it for $70,000, in that case, we sold it for a loss because the cash we received wasn't enough to cover the book value of that asset that we have to remove. If we had sold it for more than the book value, we call that a gain. And gains and losses work just like revenues and expenses. So gain, like a revenue, will always be recorded with a credit. A loss, expense, will always be recorded with a debit. So when you go to do the journal entry to dispose of an asset, the three things that will always be the same. You've always got to debit cash for however much you sold it for, because you got cash when you sold it. You've always got to debit the balance in accumulated depreciation. Yes, sir. Okay, I don't know if it will. Yes, that's the end of mine. Oh, it did a little bit.
Thank you.
Okay, we've got to debit accumulated depreciation to remove it. Because remember, accumulated depreciation is a contra asset. It has a normal credit balance. So to get rid of it, we need to debit accumulated depreciation. We're always gonna have to credit the asset that we're removing. Again, it had a debit. To get rid of it, we need to credit it to take it off. The only thing that will ever change in the journal disposals is if it's a loss, the loss is a debit. Like that, a loss is like an expense. If we were to have sold it at a gain is a credit, because a gain works just like revenue. But again, to calculate that gain or loss, all we're comparing is the cash we receive when we sell it compared to that book value of the asset that we're removing. Do you know about that? Thinking about other chapter 9 stuff, again, that's the big stuff. Depreciation being the biggest, being able to do those 3 depreciation methods, and then being able to calculate a gain or loss, again, understanding what it means to capitalize something. Not 100% sure about everybody else, but I know at least for me in my classes, when it comes to intangible asset, I don't worry a whole lot about those, except that you know what an intangible asset is. So again, an intangible asset is an asset that lacks physical substance. Intangible because there's nothing you can touch and hold on to as it relates to that asset. So an intangible asset lacks physical substance, gives the company some sort of exclusive right to something. So that's your trademarks, copyrights, patents, that type of thing are intangible assets. When it comes to intangibles, we do the same thing with depreciation, but for an intangible, it's called amortization. So just another term to know. You don't have to calculate amortization. It's just like straight line depreciation. So you could if you had to. But, in general, check with your teacher, because I don't know for sure, but for me, this is really what I want you to know about intangibles. The rest of the stuff in chapter 9 is not as big of a deal. They go into a whole lot more detail on intangibles. That's not as important as knowing how to do all of the different stuff for those tangible assets, depreciation, gains and losses. Other questions about anything at all, chapters 7, 8, and 9 related?
For, chapter 9, I'm still. For 2025 on the double depreciation.
Book value is always cost minus the balance and accumulated depreciation. About accumulated depreciation. Year 1, we took $48,000 in depreciation. Year 2, we took $28,800. So the total is your balance in accumulated depreciation. So to get the book value is the $120,000 cost.
More than the 120,000 to divided by 5, is that 121, or is that correct? The 2 divided by 5?
It's always with double declining balance. The reason it's called double declining is we take 2 times the straight line rate. It'll always be the book value times 2 over the useful life.
Okay.
And it's that same amount or that same fraction every single year.
Every year.
Yep, it's always 2/5 if it's 5. If it's a 3-year life, we take 2/3. A 10-year life, we take 2/10. It's always 2 divided by whatever the useful life is.
So just to make sure this is straight, in order to get the balance, 40,000, we subtract it from, I'm sorry, you get it from the, wait, you get the book value is the total of 48,000. To get the 72, in order to get the, balance, the 76,800, add that to the first depreciation. 76. Subtract 2,000 minus that 28,800 to get the 40,000.
Definitely do that.
Okay.
And that will always, so yeah, if that makes more sense to you, then that absolutely works. Anything else? Well, then we will, Claudette, thank you all for coming and joining me. If you didn't sign in when you came in, please do so, just so the Learn Commons has a record of how many people were here. I'm gonna stop sharing and that recording.